Good afternoon, everyone. Welcome to the Atlanta Economic Club's April webinar. For those of you that have been a part of the club before, welcome back. If this is your first event, I hope you find it worthwhile, decide to come back for more. It was a real pleasure seeing a lot of you at last month's event at Cox. It was the first time we had an in-person event in quite a while, and it was good to get back out there. And then others I saw at the Economic Collaborative of Atlanta Area Academic Institutions. They had their sort of keynote event at the Federal Reserve last month also. These webinars are great. There's a lot of benefits from being able to do things virtually, but there's nothing really quite like meeting face to face. I think going forward, our plan is to try and do more of that than we did this year and get back to more normal operations. I'm really excited about today's topic. The program committee on the board always tries to find sort of relevant speakers and content for these webinars. This is no exception. I think our general review going into planning this month's webinar wasn't necessarily to talk about some of the recent events that went on in the banking sector connected to startups, but it just kind of worked out that way. So we kind of fell into a very relevant topic here. Before we kick things off, I just wanted to take a couple of minutes just for club business. A reminder that our next meeting is in May on the 17th. So again, the third Wednesday of the month, same time, 12 o'clock. Be on the lookout for emails for details on that event in upcoming weeks. The second thing is just a reminder that the AEC's board is holding elections over the next few weeks. So for those of you that are relatively new to the AEC, we hold these board elections for executive positions on the board. So president, vice president, treasurer, secretary, right? These positions are up for election every 2 years, with the other positions on the board appointed after that the executive board is set. We had a little bit of attrition from the board over the last year or so. So thanks to all of you that have expressed interest in helping out on the board or expressing some willingness to serve on the board. And for those on the board that are currently on the board that are willing to step up and take larger roles. It's all appreciated. The AEC is all volunteer work. Nobody gets paid for any of this, so all the time that gets dedicated by the board, certainly appreciated. Still a little bit of time to throw your name into the hat for the board positions this year. So if you have any interest, just contact us over the next week or so. We conduct these elections through email, so just be on the lookout for election announcements soon for the people that are on the ballot for election, and I'll wait for you to vote for your pick. We'll hold these elections over the next few weeks, and then by the time we get to our main meeting, we should have results as to what the board's going to be. Now, with all that out of the way, I just wanted to introduce our speaker. Christina Russ is the head of strategic investment initiatives at Truist Ventures, which is the venture capital arm of Truist Financial. She's also the co-founder and the founding partner of Empire Angels, which is a New York-based fund and angel network of young professionals investing in early-stage startups with a focus on supporting millennial entrepreneurs. Christina was previously the director of European investments for Samsung Next, which is an early-stage venture capital fund investing in software and services across mobile and consumer electronics. And she started her career in capital markets at Citigroup in New York. She's a regular contributor on startups and leadership for the Wall Street Journal and sits on venture fund advisory boards in both the U.S. and South America. She's also given a TEDx talk and was recognized by the New York Business Journal as a 2016 Woman of Influence, by Business Insider as a Woman to Watch in Venture Capital in 2018, and by Management Today in the Daily Telegraph as one of Britain's 35 women under 35 in 2019. So very glad to have Christina here to talk a little bit about startup culture, the venture capital environment, and I'll pass it over to you.
Great. Thanks so much, Ibrahim, and thank you all so much for having me. Very happy to be here and join your April meeting. I'll talk a little bit about, you've heard my bio. I've never actually had my bio read out to me before, so kind of fun to listen to, but happy to walk through a little bit about just venture capital sort of 101, things that are happening in the market, the way that we approach corporate venture capital at Truist Ventures, and then a little bit about a couple of areas that we are kind of excited about right now. But feel free to pop in with questions as we go, and I'm excited to share with you today. And we'll make sure that the slides are So just to sort of lay a baseline for everybody, I don't know how familiar this group is with sort of the private funding landscape. I started out as an angel investor in New York when I was in banking. I had a lot of friends who were joining startups or starting their own companies and asking me to invest, and I didn't want to just give them money because I liked them and hoped that they did well. That felt a little bit more like a charity project. And so I got together with a group of friends and we convinced some intrepid entrepreneurs to come pitch us after work one night. And over time grew it into this angel network called Empire Angels, which is now about 70 young professionals investing in early stage companies together. And that was, for me, a really great entree into the early stage investing space. We started out doing a lot of tech-enabled investing, but over time have done brick and mortar, CPG, food and beverage. We invested in a Broadway musical, so a really wide variety of things, and some of which have done exceptionally well, and some that have been total failures. But a really wonderful introduction to this space for me. And I'd always been really interested in technology, despite having been a finance and philosophy major in college. I had always worked for startups and small businesses as my summer jobs. I taught myself HTML in middle school so that I could build a really excellent Buffy the Vampire Slayer fan site back in the day on GeoCities. And so I'd always had a strong interest in technology, and for me, getting into investing was just a really great way to scratch that itch. And I spent a little bit of time as an operator, as the first non-engineering hire for a venture-backed company when I left banking. So I ultimately have really enjoyed the investing side, but got into it through angel investing. And so obviously most people are probably familiar with venture capital funds, GPs, general partners who take money from other investors, pool it together, and then invest in companies. Very similar to private equity, but in venture, you're often focusing on always making minority investments in companies as opposed to majority, generally in private equity. And the structures can be both debt instruments and equity, depending on kind of the stage and the opportunity. And funds run the gamut from very early stage, so companies that just have a couple of people with an idea, all the way to those with large revenues and names that people have heard of. That's more in the kind of growth equity space. A version of the venture capital fund also applies to corporate venture capital, where companies like ours, Truist, are taking money generally from their own balance sheet and either investing it directly or putting it into a vehicle and investing that into early stage companies. Those typically are strategically driven in sort of the reason for doing those investments. They are investing in things that are aligned with the corporate strategy or the spaces and businesses that particular corporation is already operating in or interested in getting into. But then you also have some over time that are investing more broadly, and maybe get into more sort of financial returns driven investing, and then often at later down the line, corporations consider spinning out those teams and those funds into a separate legal vehicle, and sometimes taking on additional LP partners, limited partners, to round out that fund and have it sit to the side of the corporation. But the vast majority of corporate venture capital is investing from the balance sheet or dedicated capital into things that are really strategic for that business. And then lastly, you obviously have lots of other institutional investors now who invest in startups and scale ups, whether it's family offices or pension funds or the Tiger Globals and Fidelities of the world that have shifted to investing in these kinds of private market assets over the last decade or so as they've been chasing yield. I think with the current economic environment, we're now seeing a lot of that late stage capital move back out because there are other places to put it to work. But just talking a little bit about the venture market, I think, as mentioned, we've seen a huge influx of dollars into this space over the last 5 to 10 years. It's expanded really, really rapidly. I think both as particularly, the U.S. and other countries have experienced a growth in entrepreneurship and sort of new company formation. as well as just the opportunity for really outsized returns if you're able to pick winners on the investor side. We'd seen a huge buildup over the last several years, both in terms of amounts raised by venture capital funds, funds out in Silicon Valley that had been managing several $100 million, now managing billions of dollars in single funds, as well as just the number of new managers coming into the space. So more and more people getting active in wanting to invest, particularly at the early stages. So lots more funds formed. And as a result, there's just been a lot of money to be deployed, and so a lot more opportunities that are getting funded. And so we've seen a really massive increase in the deal count and the dollars being invested in startups over the last several years. That has dramatically shifted this last sort of end of last year and into this first quarter. But interestingly, despite being down year over year, the deal count is actually still higher than it was pre-COVID. So there's still a lot of activity in the market, and for better or worse, there's a lot of dry powder out there that needs to be deployed. And we're seeing a shift away from the growth stage investing back into the early stages, where when you're writing a check into a company that has just started over the last year or two, your time horizon for that investment is generally about 10 years. Till you would be looking for an exit. And so it gives everyone a lot more breathing room than if you're investing in a later stage company and the expectation is that you need to make a return in the next 2 to 3 years. So that's why we're seeing a shift back down to early stage, a lot more activity there, and still quite a number of deals getting done. There are no tech IPOs happening at the moment. Anyone who had filed and hoped to do an IPO over the last few years is just sitting on the shelf right now. We don't expect that to change dramatically in certainly the first half of this year. If anything, depending on what happens, sort of the macro environment, maybe later this year in the fall, we might see some things come to market. But most companies are pretty well sustained right now in terms of cash on hand. They've been able to raise from insiders, so existing investors, and cut their burn, so the amount of money that they're spending every month, reducing headcount, and that's everything from the big tech companies you read about in the paper to the smallest ones. Everyone is looking to trim their expenses and make sure that they actually have a sustainable business model, which, for better or worse, is not something that has been a question on most people's minds over the last several years. It's really been about growth, and there will always be more money that you can burn in that growth fire, as long as you're getting bigger. And that has shifted dramatically back to what are the fundamentals of your business? Do you have good unit economics? Is this a business that is driving real revenue, sustainable revenue? And those are the businesses that can get funded. It's no longer about the growth story. And this is very cyclical. This is absolutely, the kinds of stories that were being, told, I'd say post 2009 recession. And we'll eventually, see it go back up, and there will be a new bubble formed, and that's just sort of how this roller coaster tends to ride. But we're back into getting back to fundamentals, which makes it a really interesting time to be investing. And so, despite, I think as we have on here, that capital flows into some of these the proliferation, I suppose, of new investors has slowed a bit. There's just a lot of money that needs to be put to work, and so there's a lot of opportunity if you are investing right now to find companies that are at very attractive valuations, building really strong products with business models that make sense. And some of the best companies are generally built in more difficult economic times, as we know. So it's actually a really great time to be investing if you have that opportunity. I'll stop here for a second and ask if anyone has any questions on the venture market broadly, or anything that I didn't cover that would be helpful to chat about. Okay. So just a little bit about Truist Ventures. So our aim is to bring surprise and delight to financial services through disruptive investment. And I think one of the wonderful things about Truist, and one of the things that attracted me to joining the bank, was the sense that it's sort of a startup, in a way, being formed through the merger of two heritage institutions, and to be able to really rethink the way that banking and financial services are delivered to our clients, from the ground up. And I think that's just a really exciting prospect, and certainly from a venture investing perspective, opens up a really incredible array of opportunities, in large part because of the diversified nature of the institution. We have a hand in so many different businesses, that there are always interesting things being built outside of our walls, that we want to learn about and support and hopefully work with at some point. So we're a very strategically driven fund, and we stay very close with our corporate strategy team, and the leadership of our various business units to ensure that we know what's on their strategic roadmap, what are the gaps, where can we help to fill those potentially with things that we're seeing in the market, but also really motivated to learn as well. I think I have maybe on a future slide talk a little bit more about that, but also making investments to further the knowledge that we have within the institution about cutting edge areas of technology that are relevant for our businesses, and also sharing our knowledge and our subject matter expertise across the bank with outside operators and builders, to help their products scale and be stronger. And so we think a lot about opportunity ways that we can really support companies that we work with. And this is true even for companies that we may not necessarily be investing in immediately. But I think we really try to be an intake and an opportunity to help leverage entrepreneurs and their companies across the enterprise. I think the place that we sit within the organization is really helpful. Different corporations set up their sort of strategic investment teams differently. Some have it sort of in line with a particular business or vertical, and others have it sort of sit at the enterprise level. I think at the enterprise level, we have the advantage of being able to see across all the different businesses, and even if the opportunity doesn't work, for one area that may be the normal entry point into a bank for that company, we may know about 2 or 3 other places in the bank that have a project or an opportunity that particular company could be a fit for, and so it can help them really navigate that opportunity. I think partnerships with large companies are always challenging to navigate, especially from the outside. And we really try to work with companies to really further, their goals and aspirations in a meaningful way, and try to get them certainly if at least one or 2 at bats, and can talk a little bit behind the scenes and be an advocate for them, which I think is really, really valuable. And I think another thing that's really unique about sort of the place that we sit and the activity that we have is that we're able to be that advocate, and have access to the most senior leadership within the institution who are really bought into the purpose and mission of the venture group. It's really energizing to hear, Bill Rogers, our CEO, talk about how excited he is about the portfolio and the work that we're doing and the exciting things that we're bringing to the organization. So it's great to have that connectivity with our senior leadership, and to have all their support. As I mentioned before, we think about our investing in buckets. We are a stage agnostic investor, so we will do both early, mid, and growth stage investing, and we do both directly into companies as well as LP checks into funds. And we're usually investing directly into companies where we have either an opportunity that we've identified to potentially commercialize and partner with that company across the bank, and or have a really strong investment thesis around a space. And I'll share a little bit about one of our recent investment theses in a few minutes. But on the indirect side, on the LP side, we're investing in funds that can help to, certainly supplement our direct deal flow. So they have, different networks, different geographies, different focus areas that would help to ensure that we're seeing, the best deals from around the world that could be relevant for us. And then also supplement with new subject matter expertise. So GPs who have really particular, unique investment thesis in an area or background in a vertical that's important to us, and that we feel like we need really specialized sort of eyes and ears. But the buckets that we think about for these investments are to commercialize, so opportunities to bring in those partnerships and either deepen or broaden them across the institution. To learn, increasingly we're doing more investments that are in teams, products, markets that we just want to stay close to and be helpful to and learn from, and then hopefully we can find some way to potentially work together down the road. I would certainly put blockchain into that category. We are an anchor investors in two funds, Pantera Capital out of San Francisco, and which is a very large fund investing across blockchain, and then a much smaller fund out of Miami called Future Perfect Ventures, who has a female GP who's on her third fund and has been investing in the space for a really long time. And so we're able to kind of barbell that space and make sure that we're seeing all of the super early stuff that FPV may be looking at, as well as maybe some of the bigger, flashier Silicon Valley deals that some of the larger funds spend time on. So that's been really wonderful for us, and we're able to bring the expertise of those GPs and partnerships into the bank, into different forums with our executives, with leaders across the bank. And anytime we're talking about a potential use case for blockchain, we can bring in their eyes and ears on that project and get their feedback and make sure that we're thinking about it in the right way, asking the right questions, and aware of anything else that may be being done outside of the bank that we should pay attention to that would be relevant for it. And then lastly, we invest for social impact. Truist is a purpose-driven bank to inspire and build better lives in communities. That's not the kind of purpose and mission statement that you hear from a lot of financial institutions, and I think it's wonderfully unique and a special approach that we take. And so for us, affecting social change means investing in things like sustainability to help us reach both our sustainability goals, but also those of our clients. Ensuring that we're funding as many diverse entrepreneurs and GPs as possible. Ensuring more financial access and equity across the communities that we're a part of. All of that plays into that particular area. And it's worth noting that none of these have to be siloed from each other. We are ideally investing in companies where we check all three of these boxes, or they fit in all three categories. Those are the best investments that we can find. We have a question. There's a recent article in the New York Times recounting the various enforcement and civil actions arising out of fake it until you make it activities. How much of an impact in fundraising for VC funds and investment activities has this had? Yes, that's a great question. Yeah, I mean, I think that is that's very demonstrative of the period that we're coming out of, which was very much growth focused. And the only thing that really mattered to a lot of investors was how quickly you were growing, and how great of a story, frankly, that you could tell about it. And I think that is, to me, always a sign of a clear, bubble. And I think we talked about it, certainly in our team all the time, that valuations of companies we were looking at were astronomical and didn't make sense. And so we are very disciplined investors, and so we passed on a lot of things that we just didn't feel comfortable with in that regard. And I would say in my time as an investor over the years, I've learned that there's a certain amount of sales that's happening when you're pitching investors, and that's important to be selling a vision of what you can accomplish, because regardless of where you're starting, you're probably going to change and pivot and do things differently. And ultimately, companies are just collections of people. So you're trying to, invest in the best people and hope that they, are able to make the right decisions with the right guidance and support from you as the investor. But I do think that there is a lot more attention being paid, rightly so now, to numbers and assumptions. Again, projections and telling a good story about the growth that your company could have is one thing. It's another when you dig down into the assumptions underlying that and try to determine whether or not those are logical and possible and make sense. And I think there's a lot more of those questions being asked now as a result. It's very easy. I think I always found this. I still find this when I meet with entrepreneurs who are telling me about the exciting thing that they're building, and I get really jazzed about the vision that they are sort of painting for me. And you have to always remind yourself that you don't want to get too overexcited about anything. You want to make sure that you're asking the right questions and being really rational about it, and doing the proper work and the diligence to determine if something is worth moving forward on. And you have to be able to as they say in writing, kill your darlings. You have to be willing to say no and pull back on something if you aren't comfortable with something that you find in diligence, and really trust your gut. I think that has always at least worked well for me, and I think that it's very easy to convince yourself to get excited about something and overlook things that you may be less comfortable with if you aren't careful. So I think generally there's been a really I think this pullback has been really positive. It to me, having gone through a couple of economic cycles in this space, I think it's ultimately all good, and you have to hope that people learn from the froth that we've just moved out of, and stick to some of these fundamentals more over time. But I do think things, some of the big things that have been reported in the press, make everyone hopefully a little bit better and a little more critical as they're looking at things. And I've also found a pretty stark difference in from my time working in Europe versus the US. And European investors have always gotten I think a bit of guff for always being very focused on fundamentals and business models and unit economics, and even for really early stage companies, wanting to understand the business plan. That is a very, very, very different than sort of the Silicon Valley mentality and model. And I think everyone is moving more towards that mindset now. But I'm sure it will shift back again over time. So from a VC fund perspective, I don't know if it's so much some of the big stories in the market as it is just late stage investors and large institutional investors, or people who had been writing a lot of LP checks, maybe into first time or emerging managers, pulling back. So I think that's a challenge at the particular early stage. But even for some of the really large institutional investors that have been long on VC for many years, you're starting to see people pull back on the amount that they're dedicating to VC, because they can look for yield elsewhere. And as a result, some of the big VC funds are starting to look to other geographies in the world where there might still be capital and interest in getting into those funds. So it'll be interesting to see, I think, going into next year, what things look like for that vintage of funds. There we go. So in terms of areas that we spend a lot of time on, we put together a list of investment themes based on some of the sort of common areas that we found, various areas across the institution we're looking to move on, which I think was really helpful and helped to obviously inform where we spend our time and the kinds of companies that we get excited about. Digitization, unsurprisingly, is probably the number one and fundamental building block There's still a lot that needs to be digitized in financial services, and so there's lots of interesting companies building things there. Automation and self-service tools, I think, go hand in hand with that digitization. Once you digitize things, what can you do with it? And helping things to be more automated, or for employees or clients to be able to do things more easily and seamlessly themselves, particularly with cloud-based solutions, is an area we're always interested in. Data intelligence, the idea of being able to pull data from different sources, normalize it, and then analyze it and provide insights off of it. There's a famous sort of saying from a partner at Sequoia Capital, one of the large funds in Silicon Valley, that data is the new oil. That's been true for a number of years now. But I think especially with all the activity around AI right now, which we can talk about, data is very, very valuable. And the question is, who do you want to give access to that data, and how do you want to utilize it? And if you're able to unlock that data and use it in an interesting way, it can be really, really powerful for transforming businesses. And I think that's absolutely true for banks. And then lastly is embedded finance, which is the idea of providing financial services sort of at the moment in time, or the point of need for a client. And we'll talk a little bit more about that as well, because we've done a deep dive into that space recently. I have another question. What kinds of opportunities are you seeing to utilize blockchain within the bank that's in line with your investment thesis? I think blockchain is, I think there's still a lot of chatter around blockchain. I think ultimately there are still a number of questions to be answered as to where blockchain is better than other options. I think there's a lot of things around, to our point around sort of automation, where blockchain can be utilized really effectively. We think of a lot of sort of like middle and back office processes. There's always been a lot of talk and activity, I think, over the last couple of years, particularly for some of the larger financial institutions, around trading and tokenizing assets, real world assets, as an example. So taking a real estate asset, tokenizing it so that you can actually trade those assets really easily. I think that's where we'll continue to see more of the activity and success for now. And I think there's lots of experimenting happening around blockchain, and it tends to be right now very sort of institution to institution, or just within an individual institution, or around a private blockchain being built for an individual use case. Another one. So this is just a little bit on our portfolio. So we have, we had a handful of investments that we inherited from the heritage institutions, but most of these are ones that our team has done over the last couple of years. And we're really proud of the diversity of companies and spaces that we invest in. About 80% of our portfolio is actively engaged with Truist at any given time on potential partnership opportunities. And we're increasingly doing more of these sort of early stage investments to learn, where it's a team and a product that we're excited about, and we're working with them to try to find ways that we could potentially leverage it over time. And an example that's on here is actually speaking to blockchain, is a company called Spectral. They focus around credit risk infrastructure, bridging on-chain and off-chain activity, which is a very sort of practical application around blockchain. Method is another on here that we closed earlier this year, that has built a universal debt API where a consumer can just very easily enter their phone number, and it can collect all of their debt information in one place. And can both pull that information and then push payment. So there's a lot of interesting experiences that you can build off of that. Think of a debt consolidation loan, for example, or personal financial management And it's a persistent connection, and so that those can be constantly updated. And they've just built it in a very sort of seamless way for the consumer and a very easy way for a partner to be able to utilize and build experiences off of. And then these are also some of our fund investments that we've done. We are anchor investors in a lot of the funds that we are a part of, and actually announcing another one tomorrow. So if you read TechCrunch, you can see our latest fund investment there. So just a couple areas I thought might be interesting to chat a little bit about. Embedded finance, I mentioned, is one of the themes that we're focused on at Ventures, and I think it probably doesn't come as a surprise that with the growth of software as a service, SaaS, over time, people have come to the realization that reliable, consistent revenues are much better than episodic ones. You look at Netflix or Amazon Prime or any of the other great examples of subscription services that have been really successful. Now there is an opportunity, thanks to more open banking and adoption of cloud and API usage within financial services, to take something that may have been a single service and start building a sort of fully vertical solution, for a given segment. And so that may have originally started with just embedding payments in that product, but now we're starting to see a whole host of opportunities to bring more complex and a wider variety of financial services into those platforms. And that goes both ways. The way that we talk about it, and sort of our thesis from a bank perspective, is that you can feed the platform. So you can take your services and embed them in other people's platforms. And examples of that would be even just taking your payment products and putting that into a vertical solution, into a QuickBooks or into a point of sale system. And so you can be the one providing that financial service to another platform that may be vertically specialized. But you can also take other people's services where it may not even be, most likely it may not be a financial service, but embedding their services into your platform. And that's where you can be the platform. And so what would it look like if you were a small business, and instead of just opening up your banking account information online and seeing your balances and maybe being able to do some invoice payment, you actually had a dashboard where you could run your whole business from within your banking experience. And what are all of the different aspects of running that small business and the different systems that you would want to integrate and feed data. And we're back to that concept of data intelligence, feed that data into that dashboard, and be able to provide you insights and analytics and scenario analysis and various ways to look at that data and then actually be able to execute off it. So embedded finance, in our view, really goes between taking your products and putting them elsewhere, as well as taking other products and bringing them into your experience. And this is more where we think about the why taking financial services and putting them elsewhere is such an interesting opportunity. You have lots of different products from across financial services, and again, the reason that these can now be leveraged and put elsewhere is because of the growth and proliferation of APIs, and there's an entire segment of companies that just focus on being that enabler layer, taking the data and service from the financial institution or the entity providing the product service, and helping to get that into the vertical provider. And we have different kinds of platforms that we talked a little bit about here. Payment processors like Stripe, which I'm sure you're familiar with. Mindbody is a vertical SaaS that if you are big in the sort of athletic and training class space, you've probably reserved something through Mindbody. before. But MindBody has both a consumer-facing, booking side to it, and booking and payment side, I should say, as well as a business management capabilities for studios and gyms. And so, as a studio or gym owner or operator, what are the kinds of things that you may need from a financial services perspective, instead of having to go to a bank or to, multiple other online providers for something. Wouldn't it be great if you could just embed those things into a single application and run everything from there? And then marketplace is obviously also a place where you see a lot of embedded offerings over time. And so we're looking at a variety of areas where we can help enable banks to take their products and link them up into these marketplaces. And obviously this is a fast growing trend that we'll continue to see grow over several more years. But it really is driven by the clear movement towards more digital products and digital utilization across a variety of areas in financial services. Consumer payments, unsurprisingly, is really the behemoth here. But just the shift to e-commerce and more comfort around electronic payments by consumers just allows for a really wide variety of experiences to be imagined and enabled through embedded finance. Banking and cards. You may have heard of the concept of virtual cards, which are growing quite rapidly, which is the idea that instead of having to have a physical card or a single card where everything is going, you can actually very easily spin up individual cards and numbers to be used on the consumer side for, say you want to have one card for all of your utilities, you want a different card for your personal subscription services, you want another card to pay for anything related to school for your kids, whatever it might be. You can have individual cards for each of those, and they can have different limits and requirements on them, and can be more easily managed than having everything in a single place. Similarly, in the commercial space, virtual cards are really interesting in spaces like fleet management, where you want to be able to put certain restrictions and be able to see more data around how that card is being utilized by a driver, for example. So lots of interesting things happening around banking and cards, and being able to embed different services, financial services within a platform offering. B2B payments, also interesting for this. We've been looking at an interesting company based in San Francisco that is basically building the sort of buy now, pay later for B2B payments, where you could embed that into a treasury solution product or directly into a payments platform that your vendors or suppliers might use. So I think a lot of embedded finance gets talked about in the context of consumer, but there are also really interesting opportunities on the kind of commercial and B2B side as well. And then obviously business lending is lending of any kind, but particularly business lending is a really interesting opportunity. That going back to that MindBody example, or Square would be another really good example around small business, being able to offer a loan product that's particularly specifically tailored to the needs and business model and performance of a customer on one of those platforms, directly within that experience. Any questions? Okay. And then the other area that I'm sure people have been reading about in the paper is generative AI, OpenAI being the most sort of prominent in this space. I think the venture community always picks something to get excited about every year, and this year it's generative AI. These are not new concepts. I think it's the fact that this is now being actually exposed to the public in a fairly usable way for the first time, that is what's getting everyone quite amped up. And anytime something like one of these spaces gets really exciting, there's lots and lots of deal activity. Everyone's trying to find something to invest in. All of the big funds will be looking for some bet to make. I think for financial services, I think there's a lot of really interesting applications around AI and generative AI. I don't think that that's news to anyone. Certainly anything around sort of model testing and design. Obviously, applications around customer service and account servicing and improving the interactions with virtual assistants. I think it's actually the areas that I get most excited about are things like scenario analysis and sort of question answering, I suppose, in more of an account context. So if you're a business banker, being able to ask a question with natural language about one of your clients or their business, and having that analysis done and fed back to you, so that then you can spend your time not necessarily having to run the numbers or find that information or analyze that, but take that information and put it in the context of a wider picture, and then be able to provide better advisory to a client. I think those kinds of opportunities are really interesting. I think there are also applications around wealth management for that too. And I think, just broadly within this generative AI space, there's lots of models being built. And it's really not so much, it seems, about the models themselves, but what data they're trained on. And so what we predict will likely happen is there will be, lots and lots of models. The question is, what data do those get access to? You can certainly see a company like Microsoft, offering a generative AI model to each of their, individual corporate clients that use, Microsoft Office and 365, and say, you can have this model that has been, trained and is publicly available, but you can have a private version of it that's just trained on the data in your business. And so it only answers questions and is relevant for the data around your specific business and needs, not the entire world. I think ultimately that's where the value really comes in these models, is training them on particular kinds of data sets and privatizing them versus the sort of the larger public models that people are playing around with right now. But it'll be an interesting space to stay close to, and there will certainly be lots of interesting companies built around the space. So that's all I've got today. Happy to answer any other questions that anybody has, or if there's any topics I didn't cover that you'd like me to spend a few minutes on.
Thanks for that, Christina. I have a couple of questions that I think are pretty interesting facing this space. The first kind of deals with the idea behind regulation within the venture capital space. I'm wondering if you, especially in the aftermath of sort of the collapse of SVB and Signature Bank, whether or not you see any changes like on the horizon from a regulatory standpoint on how VCs sort of operate.
I don't think that the issues around those banks necessarily had anything to do with the way that venture capital firms operate. Those were different issues. But I certainly think that one of the things that, one of the reasons that so many funds and startups wanted to bank with those institutions is because they provided services and in a very personalized and customized way that you can't get elsewhere for that industry. And so I think there's certainly an opportunity for for other institutions to consider whether there are ways for them to tailor their products and services to meet the needs of that industry more readily. But from a regulatory perspective, I don't see anything happening for venture funds specifically, because I don't see a tie necessarily between what happened to those banks and how venture funds operate.
Thanks for that. That's very interesting stuff. So another sort of question I had just sort of deals around like the appearance of these sort of bubbles in venture capital funding. Like you sort of showed at the beginning that there are these periods where venture capital funding begins to surge. Then you know, either typically there's some kind of correction later on that brings things down to more normal things. So what do you think is just like the primary catalyst for those kind of bubbles for emerging, and then sort of what snaps things back? Is is it all tied to the macroeconomic environment and policy and things like that sort of correct things?
That's such a good question. If I knew what grew bubbles, I'd probably be a much better investor because I know what was coming and be able to find those things ahead of time. I think, if I just look back over the last, 10 or so years since I've been in the space, I do think a lot of it was tied to the search for yield, and having such a low interest rate environment. There was just a lot of money that was trying to find places where it could earn some kind of a return, and venture capital is one where it's a hit driven business, and so there is that possibility through those investments, and as a result, I think you saw this huge move of money into the later stages that didn't exist before, and that got people at the earlier stages really excited that, hey, like not only can we fund these early stage companies, but they could get more money to keep growing, usually at a less sustainable way from these later stage investors who then might be, putting them out into the public markets, where public market investors may be willing to wait even longer for profitability. And so it's I think a lot of it is tied to that macro environment, at least from this last cycle. But I wish I could predict the next one.
It looks like we have a question from the attendees. But with the aftermath of SVB, a lot of venture capitalists and startups didn't know what was going to happen with their deposited money. Are there strategies that VCs are deploying given the FDIC limits? Are they trying to spread deposits out more? Or is this a risk that VCs are going to continue to take on? So sort of what's been the change of behavior like among venture capital in the aftermath there?
Well, I mean, I think we're in an interesting moment. Obviously all of that money having been fully protected. So I think in my mind, I guess there could certainly be a question as to whether or not those limits exist anymore in practice. But it's interesting. I think we've seen like reports in the news about companies and VCs wanting to go back to the newly sort of constituted Silicon Valley Bank, and just really missing that experience that they had there. I think we'll have to see. I think in the heat of the moment, I think everyone quickly realized that you should probably be have multiple banking relationships. That there's a lot of value in not relying on any single institution. And so, I would certainly expect both funds and startups to, be more strategic in the way that they manage their deposits and the relationships they have, just so that they have an air bubble in the event that they need it. But yeah, I mean, I think it'll be interesting to see where who sort of benefits from some of this turmoil, because Silicon Valley Bank had that market pretty captive, and I'll be curious to see what institutions pop up wanting to serve the needs of those particular segments, because they are a little bit more unique.
And then just one last on my end, because I know we're running up against time here, but I was just curious as to whether or not there were any industries that Truist isn't currently actively investing in that you think are just attractive options, or kind of places you wish you were in but aren't currently there.
That's a great question. I think, like I said, I think one of the things that's really great about Truist is that we are so diversified. There's not really an area that we don't touch. I do think that there's, there's a lot of interesting activity happening around sort of technology for capital markets. That isn't an area that we spend quite as much time in, but where I think, just based on my experience in that space early in my career, like there's a lot of opportunity to bring more technology to make that a better experience for both, on the investing side and investor side and the sort of structuring side. So I think there's a lot of interesting stuff happening in that space right now that I've been paying a little bit of attention to, but not quite as much.
Thanks. Yeah, I mean, again, we're running up. I want to be respectful of everybody's time. I just wanted to take the time to say thank you again. This is a very informative kind of presentation here. I actually spent a good amount of time in the startup space myself, but just working for one of these early stage startups, and it's a completely different kind of way of doing business out there. So very insightful commentary. Thanks again, just for all of your insights here.
No, my pleasure. And I think you guys are really fortunate to be in a city that has such a robust startup community and a really great ecosystem. So, to the extent anyone's interested in getting involved, there are some, great angel opportunities, and Georgia Tech has a lot of great programs, and Atlanta has a lot going on. So you're very lucky to be in that place if you want to get involved in this space.
So again, thanks a lot. Just a reminder to everybody here, next meeting is on the 17th of May. Be on the lookout for emails about that, and also emails about the upcoming elections here for the board. Again, thanks everybody for coming and spending some time with us.
Thank you.